Hi, everyone. Thank you for joining us today. My name is Marcia Butler. I'm the webinar director here at Advice Chaser. As you're coming in the webinar room and as we're getting ready to go, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries during our presentation today or during the question and answer session at the end of the presentation. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your contact information, and we're happy to have someone reach out to you after today's event to get that addressed. Again, we want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd like to introduce you to our presenter today. Robert DiPaolo has been in the financial services industry for over 16 years. He received his BBA in finance from Hofstra University, as well as a JD from Hofstra Law. He started his career as an advisor and an equities broker-dealer and was the managing director of a hedge fund, as well as a partner at another mutual insurance company prior to joining National Financial Network. Robert enjoys helping people identify their goals and design strategic financial plans to move towards achieving those goals. Robert is a certified exit planner, and this prestigious designation is held by less than 350 people nationally. As a director of business planning, Robert has a strong understanding of helping business owners find their why to design the most efficient plan to achieve both business and personal goals. He believes the greatest reward is not only personal advancement, but assisting others to achieve their peak potential. And I'm going to go ahead and turn over the time to you, Robert, and glad to have you on today.
Thank you for letting me speak today. And today we're going to get on to a very important topic because many business owners look at their gross, they look at their net, they look at what they're making, but they don't take the time to take a step back to see if the way they're compensating themselves and their employees is the most efficient or the most ideal situation for what they're trying to achieve. So pausing for a moment to take a step back, to analyze your situation, analyze what options you have in front of you is usually a great starting point to dig into some business planning, because as many people say, many business owners work in their business, not so much on their business. And this is one of those overlooked points that can raise efficiency and raise the bottom line of your business with just a little bit of effort, because we all know how much harder it is to raise the top line of our business. If we can make our business more efficient of what we're already doing, it is exponential in the results we can get. So today's topic is really going to break down into 2 points. The first is owner compensation strategies. Being that you're an owner, there's many ways you can pay yourself. Do you take a salary? Do you take a distribution? Does everything come in K1? How does that work? Do you take loans? There's many different ways owners find to pay themselves. Are you doing what's most efficient for your business? Are you doing what's most efficient for your business today? Are you doing what's most efficient for your business in the long term? Are you doing what's best for your retirement planning, for mitigating taxes today? There's many different components that go into it. There's many different philosophies. We personally believe that balancing them out and mitigating some tax today without having a burden being shifted to later is crucial. And if there's ways to shift and compensate yourself with just how you classify it, makes a big difference. There's advantages to taking part of your income as a salary sometimes. There's advantages to taking things as an owner's distribution. There's advantages to a lot of different ways in order to compensate themselves. You just have to know the variations and know what makes the most sense for what you're looking to achieve. And sometimes it's maybe not just what you're doing in this one business, but how does this affect your overall income structure and your own overall tax situation personally? Because many business owners have multiple streams of income. So when you have multiple streams of income in, it's not just a siloed approach for one business. You have to look at that business of what's most efficient for that business for the owner to be compensated, as well as how does that play into the overall compensation of an owner when you take into other assets, other investments, other businesses they may own that may be drawing other income to their personal tax return. But aside from just the owner, you have to plan for your employees. Employee compensation strategies take many forms. You have everything from your rank and file employees to your mid-level managers to your key executives who don't have an equity stake in your business, but are vital to the growth and accomplishment of your corporate goals. So if your company is looking to accomplish something, we all know who those key players are who drive the business forward, who those key players are who make sure that your business is situated to best move towards your goal. We also know who the middle file is, as well as your rank and file employees who are the most expendable and replaceable. You have to design strategies that reward and entice people at all levels and achieve the goals that you're looking to accomplish. And as we look into that today, we're going to break it down into many different components. And again, this is not a solution for one person. This is really the components that go into making the strategy and what's needed to really analyze and design what's best for your situation when you're working with your advisor. So going from there, first thing we talk about is tax mitigation. I know I mentioned this slightly, but how you pay somebody, how you pay yourself, how you pay an employee has different tax ramifications depending on factors. One might be, how's your business structured? Are you a C Corp, or you're an S Corp, or you're an LLC? Each one has different ramifications on how you pay certain things. How are you handling certain things? So you may pay the employee the same amount of money, or you may pay yourself the same amount of money. One may have a 10 to 15% higher tax expense to it versus if you do another. So are you analyzing that? Are you doing things that you might be able to defer or delay some of your compensation, which will give you a tax benefit today and also not affect your personal taxes today? So there's a lot of different things we look at. We look at different solutions for different companies, different roles, different goals. So as we talk about tax mitigation, it's always in the forefront of, okay, here's how I look. Here's the components that make me up as a corporation, make me being the corporation up. Here's how my employees look. What is the best benefit to all of us with the least unnecessary tax possible? And the first place we start to talk about that is your corporate structure. Businesses really fall into 4 main categories: C Corp, S Corp, LLC, partnership. So when we talk about a partnership, there really isn't a structure. A lot of the profits, a lot of that stuff flow right through the partners in distribution equal to their share of the partnership. And that's really an extension of your personal tax return. There's really not much that's going to be played into. But once we get into the 3 main structures, the C Corp, the S Corp, the LLC, they each have their unique benefits and their unique drawbacks. So before I go too deep into each one of them, a question I like to know when I ask the crowd is, how many people here who are business owners know or can say in the chat if they're a C Corp, S Corp, or LLC?
All right, we'll give a couple seconds for people to put that in there. Looks like the majority of people are saying S Corp.
Okay, so
And
S Corp,
we have a couple with LLCs, a few more. So split between the two, LLCs and S Corp. looks like that's the main structures we're looking for, but you might as well hit on C Corps as well.
So C Corp is pretty much your traditional corporate business that you're used to seeing. Things get taxed at a corporate level. Any money that comes out of it gets taxed again. So one of the biggest drawbacks to a C Corp that a lot of people talk about is double taxation. So when you're with a smaller business on the smaller scale, this really hurts you with the double taxation. But when you start getting into larger corporations and you start getting into the multiple $1 million of revenue, unlike the S Corp and the LLC, which are pass-through entities, that money stops, the buck stops at the corporation. So the taxes that are paid at the corporate level stay at the corporate level. And whatever gets distributed out from there, depending on how you take it, gets treated from there, which on the large scale is a bonus because when you have a smaller entity, the corporate tax rate is less than overflooding your personal tax rate. So if you're a larger corporation, there are benefits to being a C Corp. If you're a smaller corporation, one of the biggest drawbacks is that double taxation. And knowing that is one of the analyzations you have to make is, hey, how big is my company? Have I reached a point that being a C Corp makes sense? You're never going to see a Facebook, an Amazon, a Google be an S Corp or an LLC because it's just too much money flowing down to the shareholders that you would just decimate their personal tax return. But when you're talking about a $1 million, $2 million, $3 million, $4 million business, and you have 2-3 partners, yeah, when it comes to net profit, it might make sense because you're saving that double taxation to be an S Corp or an LLC. So S Corp is kind of like the hybrid between the LLC and the C Corp because you have that pass-through treatment, but you have that separate entity that kind of has a lot of the nuts and bolts of what people like with the C Corp with the S Corp. The LLC is a straight pass-through entity. A lot of it flows straight through, and it's a byproduct that has a lot of things that it flows through to the person, but it takes away that liability from them personally putting it on the entity. But as far as profit, loss, and everything else, at the end of the day, everything's coming right through to the person or the owner's personal tax return. So knowing where the buck stops really helps us get into that conversation of what do I have to do to mitigate tax? Am I mitigating tax in the C Corp of how I get the money from me, from the company to me, from that double taxation? With the S Corp and the LLC, it's how do I mitigate not destroying my personal tax rate? Because all of a sudden you have a successful business that's making a lot of money. Even if you don't draw the cash out, that profit on the books of the S Corp and the LLC is going to flow right through to your personal tax return. And your personal tax rate is going to skyrocket up, which is something you have to be aware of and kind of use strategies to try to offset or try to work with the best you can.
So we
From,
I'm
sorry.
sorry, go ahead. We had a question that came in. Is there a kind of a threshold or an inflection point that makes sense financially for the tax level of a C Corp versus an S Corp?
That's a very, it depends answer, and I can't give you a hard line answer. Usually businesses north of, again, it depends on your profitability because gross revenue, top line revenue, it can be a very different thing. Like I've worked with clients whose business has a top line revenue of $15-20 million, but they're only drawing down $1 to $2 million on their net profits or their taxable income. So it really doesn't make a difference. I have other clients who are a $15 million business drawing down $14 million in profit because they're mostly consulting. Well, the problem with that is they're going to get crushed. So something like a C Corp makes more sense. So it really depends on what's flowing down to your personal tax return and how much of it's going to really make a material impact to what you're getting taxed on the personal level. So it really depends because again, if you have 5 partners and you're bringing down $2 million, that distributed across 5 partners isn't a huge hit. If all of a sudden every partner is taking a $3, $4, $5 million hit, it might be time to explore a C Corp, but it really depends on your personal situation. So there's no real cookie cutter answer. It's really a touch and feel, the art side of the science of when it becomes too much and inefficient for your personal tax return.
Thank you for that. And that kind of goes right into our next slide about ownership.
So yeah, so as we talk about ownership, as you own a business, one of the key things as you design compensation, as you design other things are, how many owners are there? Are you a solopreneur? Do you have one partner? Do you have 3 partners? Do you have 5 partners? So knowing how many owners you are helps you decide how to compensate each other and how it fits each owner's goals. One owner might have one goal, another owner might have another. So when we talk about this stuff, there's some different stuff we could get into, but for conversation purposes, how many people on this call are sole owners of a business? How many people have one partner, 2 partners? So in the chat, it would kind of be helpful. So I could kind of give some tidbits to the most popular 1 or 2 is, let me know if you're a solopreneur or if you're not a solopreneur, or if you're not a solo business owner, let me know how many partners there are to your business.
All right, we're getting some answers in here. So we've got a variety. It looks like maybe half are sole owners, and then we've got some with partners and some who are like they're a solo owner with their spouse.
Okay. So when you're the sole owner, or you're a sole owner with your spouse, this is probably the easiest situation because owner's compensation, you design what's best for you. When you have 1 partner, 2 partners, 3 partners, all of a sudden that starts changing things because one partner might be younger and single, another partner might be married and 10 to 15 years older with 2 to 3 kids. So their goals, their deductions, the things that they can do on their personal return, you have to be aware of, and you have to design a plan that's fair and equitable to both parties, because knowing your situation, knowing your partner's goals, you kind of have to find that middle ground that works. But as we're talking about that with the compensation and everything else, you also have to start thinking about, what are you hedging? What's going on there? Because one of the topics which isn't really going to come up in the slides today is, great, you have a partner, you have income, you have a business that's worth a lot of money. You always have to think about also, how am I protecting that? How am I putting a buy-sell in place? How am I putting provisions in place to protect my income and transfer the business? Because again, tax mitigation doesn't just happen on your compensation. Tax mitigation also happens on the transfer of the business, which will come up with if all of a sudden one day your business has to be transferred from you to someone else. How do you mitigate the tax exposure to that? What provisions do you have in place as far as valuation? How do you know how that's going to happen? So mitigating tax can happen on many levels when we're talking about owners. And that's another area which I get into a lot with my clients is, hey, that's great, we're talking about your tax today, but what about your retirement? What about your buyout? What about all these different components? And are we equating that into how we're distributing the money that's being used towards the owners? And is it fairly compensated to each owner in relation to their ownership? And are we taking into account when they potentially might need to be bought out, what they might potentially need for retirement, and what they might need for today, to make sure that we're mitigating tax while maximizing towards their goals? So,
We did get a question in here I
yes.
wanted to ask. So when you're a co-owner with your spouse, is that considered a sole owner? Can you talk a little bit about kind of the situation there?
So you're really not a sole owner because each person's individual. You're talking about something that comes into like more of an estate issue of transfer to a spouse upon death or upon something else, but you and your spouse are really 2 separate owners, but you're working as one because you have a common goal. You have a common, common interest, common family. Because in essence, if you guys got divorced, you still have your separate equity. If you guys separated, you still have your separate equity that you would have to buy them out because you own your ownership individually. And now again, depending on the state, depending on where you are, there's different laws, marital property, not marital property. I don't really want to get into that. But you guys on paper are 2 separate owners and partners. Now, I would treat it like a true partnership, but knowing that your goals are so in line, it's almost like that halvesy situation that's kind of one way, kind of the other, because in reality, wink, wink, yeah, we're partners and we're working in unison. But in reality, you are still 2 separate individuals that this is getting accounted to. The same way that like you're getting paid a salary, your wife's getting paid a salary. Not everyone files jointly. Some people file married, filed separately. Some people do different things. So in essence of everything, you are two partners. It's no different than if you had a complete stranger as your partner, but it just seems that a lot of your goals align better and you can kind of mitigate and maximize things when your spouse is your partner. So now when we get into your employees, it's different. So how many employees you have, how many of those are key employees, and how they will be affected by certain things comes into play. So when I talk to business owners, the amount of employees you have really change how you view employee planning. So if you have 1 to 5 employees, it's going to be very different than if you had 15 employees, which would be very different if you had 150 employees. So again, what I like to do is try to talk to what's most important to the group on the line. And so if you could put in the chat, if you have 0 to 10 employees, 10 to 25 employees, 25 to 50 employees, 50 plus employees, that'd be helpful. I could hit on some points to the primary groups that we're talking to today.
All right, again, and we're just waiting for people to put their number of employees in. It looks like the bulk of them are looking at 10 or less employees. So that's where it looks like most of them are at that level there.
Okay. So again, as we talk about different levels, like the 0 to 10, the 10 to 25, 25 to 50, 50 plus, reason why we bring this up is there's different things you have to offer employees. There's different things that affect employees differently. When you have 50 plus, 100 plus employees, you have tiers of employees and tiers of management. You have your rank and file, your low-level management, mid-level management, and then senior management. So in that type of thing, in the pyramid, you kind of want to focus your attention to protecting the top, but having benefits to protect the top, but attract the bottom to be hired in those rank and file jobs that are easily replaceable. When you have a closer held business that you have 10 or fewer employees, a lot of times every employee to some level is essential. So I have some businesses I've worked with that have had 4 employees, and losing the receptionist can be devastating because of the day-to-day function of it. But you have a 20-person, 30-person employee, 20 or 30 employees, losing the receptionist may have minimal to no effect because their role is simply answering the phones, answering the door, and collecting packages. But when you have 4 or 5 employees, the receptionist is not just a receptionist. They take other managerial office functions, other things that could kind of impact your business. So knowing how many employees you have who are key and essential to operating your business, how are you rewarding them to make sure that they want to stay with you? Are they getting compensated properly for their roles? And do you have the right safeguards in place if something was to happen to them? So if your receptionist left or got disabled or something happened, you could call a temp agency. You could get a new receptionist within a week. But if you're director of sales or someone who's responsible for a key part of your business and no one else can do that function or not do that function right away, you're going to want to hedge for that. You want to make sure that they don't leave for a competitor. You want to make sure you're putting hedgings in place to protect the business and kind of design their compensation and design your strategy to reward them as much as possible, to want to stay, to want to be part of your business, to want to be involved, but also hedge for the potential loss of your business if something was to happen to them. This is where key person insurance comes into place. This is where retention bonuses come into place. This is where other compensation above and beyond what you're giving to a normal employee might be a specialized package, which again, you have to be careful with that, which we'll get into in a second, is you have certain things that when you're doing employee benefits that fall under rules called ERISA. If something falls under ERISA rules, you can't differentiate against an employee. But if a benefit is a non-ERISA benefit, you can, what we like to say, discriminate and segregate and pick a specific pool or person to get something different than everyone else. So as we look at benefits, that's another area and how we pay them. What's a bonus? What's a salary? What's a deferred compensation? Are they getting paid on a percentage of profits? Are they doing things for them to be in line with what your goals are and have no fear of you potentially losing them or them getting upset with their compensation and looking across the street to the competition to try to grab a better offer, or be swayed away by a few extra dollars, which could have been easily avoided. So those are the kind of areas we get into with that. And from there, we want to get into the planning solutions. The planning solutions take a lot of different forms, and there's a lot of different things we can do. And one of the most basic ones, and became mandatory for a lot of people, are starting with your group benefits, your health benefits. So in many states, and I know federally, you have to offer group benefits if you hit certain sizes. And I'm not going to get into those numbers because depending on where you are in the country, those are going to vary. But one of the first questions a lot of people ask when they take a job is, do you offer benefits? What benefits do you offer? How are you offering benefits? And that group dental, that group health, that group vision is an essential baseline you have to offer. And as you're offering those benefits, are you offering it in the most efficient manner? There's many different ways to structure these benefits. There's many different ways to compensate and pay for these benefits. And you want to offer the most robust group benefits possible with the least cost to you. So what do I say about that? So as we break that apart, what are you paying for? Are you paying for 50% of the bill no matter what they take? Are you paying 100% of just a single participant and they have to pay everything above? Once you decide that policy, the other part of it is, how are you designing those plans? There's many different ways to design those plans. You could go everything from a very standard traditional deductible plan, which has very low deductibles and just a copay that you pay as it goes. There's high deductible plans with health savings accounts and FSA accounts and things like that. But then there are hybrid plans that you can get a higher level plan with an HRA account, which basically means you're paying for and taking some of the risk yourself by kind of making a mid-tier. I'm going to offer my employees what's considered maybe a bronze plan, but it's going to feel like a gold, silver, or platinum plan to them, because you're going to say, I'm going to cover the delta, pay for it out of pocket. I have a fund which I've built up for that. Now, why would I do that? If you have a younger, healthier workforce that isn't going to get sick, isn't going to really use their medical benefits, you're on the hook for a bronze plan, which is usually the cheapest. That delta and the difference is probably money that you're not laying out that can be recaptured at the end of the year and kept for the business to offer something that looks and feels like a top tier benefit, but is performing, but it's only costing you that of the lower tier. Now, if you have an older workforce, this is going to still potentially be a higher cost item to you, where it might make sense to offer a true silver or gold plan, because you know that these people are going to use it. These people are going to have needs that you're going to have to pay for. So you're not going to gamble and have to pay it out of pocket, pay that delta in between. That, you know what, let me hedge and offer these plans, because I know the younger people are going to probably take the cheaper plan anyway, but I'll have the more expensive option for those who need it and want it. And it's not coming out of my pocket, but I'll call share on whatever level it is. And you kind of design those plans based on the age and demographic of your worker pool, which is, again, one area where you can offer a benefit and mitigate some costs in how you're designing compensation and benefits for your employees. From there, you can also offer supplemental things on top of it. Maybe you have highly compensated employees. Maybe you have certain employees that are making more than others. So those traditional mandatory or those mainline group benefits that you have, which are the group life, the group disability, offer up to a certain level. Many times group disability only offers up to $5,000 or $10,000 of monthly benefits, the typical range that they fall. Well, that's great for your rank and file employees. Those are great for your lower tiered employees. Maybe you're a law firm. Maybe you're an architectural firm. Maybe you're a high-end sales firm that you're getting employees that are making that $200,000, $300,000, $400,000. All of a sudden, they're making $200,000, $300,000, $400,000 a year, and they get disabled or something happens to them. What's $5,000 a month going to really do for them on disability? They're not going to be happy. They're not going to realize it. So if you could say, hey, look, we have an abundant, robust plan. We have our disability that goes up to $20,000, $30,000 a month. We have an offering that really protects you. Many employers only offer the basic group life insurance through the group benefits, which a lot of times is $100,000, maybe $250,000. Maybe you have key executives you want to do something extra and above for. And this is one area where you can add a benefit that is going to be deductible for you and not an expense that's going to hit their tax return to offer them more life insurance, a higher life insurance, and something like that to just benefit their family and just show for those executives you're doing a step above or something extra. And this is kind of where you can design things to benefit the employee and do it in an efficient way for you as the owner. And I find these solutions really good for those key people, those people who have concerns, those people who have a sole income earner who's a high earner for a family. They may have a wife, they may have 3 kids. The wife isn't working, the kids are young. The more protection, the more you give them this area might be one way to enhance their compensation at a very economical vehicle or economical cost to you, the owner. From here, there's a lot of things we get into next, which is a big topic that has come up with the Secure Act, and the Secure Act 2.0 is 401k, retirement savings. Retirement savings for many people have been a hot button topic because the more we look at it, the more we realize that Americans aren't saving the way they used to. Back in the day, we used to have pensions, we used to have mandatory savings plans that people knew that when they retired, they had enough money to live on. Then they started realizing, oh, let's switch from mandatory retirement to voluntary, kind of go to this 401k model. Well, not every company switched to a 401k and pensions went away. And what we've realized is Social Security is not enough to supplement retirement. So more and more now we're seeing, especially with the Secure Act 2.0, 401ks are becoming mandatory. Enrollment's becoming mandatory. Different aspects of it are becoming mandatory. Are you offering a 401k? Are you offering the components of the safe to a 401k that makes sense? So I guess right here is another good spot for us to pause and just see how many employers on the call or business owners on the call right now offer a 401k to their employees.
All right. I'm waiting for those to come in. We're getting a couple, and I'll give them another second or so. Okay, looks like most of the people on the call today are not offering a 401k yet. Understandable because they have a smaller company. Maybe you can talk about some options for these smaller companies.
So what I tell people, especially with those with smaller companies even, offer a 401k. The Secure Act 2.0 has all the initial setup fees that you're going to get tax credits for. It's not a deduction, it's not a percentage, it's a straight tax credit. So it's going to go and be dollar for dollar a savings to you. So it's really not going to cost you to set these plans up. And it's something that employees are looking for. Kids graduating college, younger employees that know what's going on and see what's going on, they're looking for these benefits and not offering them is sometimes something that's going to hinder somebody from being hired today. So if you're looking for a new employee and they say, hey, what are your benefits? Oh, I don't offer health. I don't offer a 401k, but the guy across the street does. You could very much lose a candidate on that alone. And by the way, it's becoming mandatory depending on where you're located. I'll use New York City as an example. New York City has a rule set that if you have 5 or more employees and you've been in business for 2 years, you must have a retirement plan. And if you don't have a retirement plan set up, they're in the process of rolling out a city and state mandated one. Now, I have nothing against the government. I have nothing against how they manage money, but looking at Social Security and looking at how other things have been managed by the government, like you look at the individual health insurance portals and everything else, they have so many moving components that they can't possibly do everything well. So if you have the option to get tax credits for this for 3 years, if you have the ability to manage and control this yourself, you are much better off having a 401k plan set up by yourself and having it managed for your company than sitting back to the point that all of a sudden you get the knock on the door that you're going to get fined if you're not enrolled in this city or state run plan because you hit a trigger or your area hit a point that had to do it. And by the way, it feels better and looks better when you're picking the solution that your employees are getting versus just the generic default that you're mandated into. Now, beyond just offering the 401k, there's a few components that tie to it. And the first one I'm going to talk to while we're still here is the employer match. So now employers are allowed to match. One of the most common matches is called a safe harbor match. A safe harbor match can take a few different forms, which can either be a 3% for all employees or dollar for dollar up to 3% of their income, another half percent for the next percent of their income, and then another half percent for the last percent of their income, which comes out to a 4 to 5 match. So if they put 5% in, you're matching 4. And now a lot of times people will do this and say, why am I going to match? Why am I giving away money? Well, a lot of times it's for greedy purposes. They have top level employees, or what they call top hat testing, which forces people at the top to have to take money back or realize it as ordinary income that they can't put away for retirement if enough people at the bottom are not contributing. So what they say is, hey, Mr. Owner, Mr. Top Earner, you can't put away money more than a certain amount unless people in the rank and file, unless income earning level are doing it as well. So what's the catch to that? If you put something called a safe harbor, which is why this is in place, it gives you a protection so that, let's say your top earners who are making a lot of money want to max it out, want to put away as much as possible. That safe harbor gives you that protection, allows them to know, hey, just because I'm making 200 and the people making 35 aren't putting in, my money that I'm putting into my retirement plan can stay on my retirement plan. It's not going to be income that I have to see today, and it's going to affect my retirement. So
we had a couple of questions that came in. I'd like to address
yes.
some of those now. So can a business owner fund their compensation into a 401k for themselves? And then a question about costs as well.
Yes. So yes, anyone who takes an income from a business can contribute a portion of that income towards a 401k plan. It could be the owner, it could be an employee, it can be anyone except an independent contractor. So 1099 independent contractors cannot be included in your 401k plan, but you have to be an employee. If you're an employee or an owner of the business, you can contribute to the 401k, but you all stick to the same rules, which means that personal contribution can exceed, last year was 20,500. I believe it's 22. Don't hold me to the exact dollar. I believe it's 22 and change for 2023. But on the flip side, there is the match portion and the next portion we're talking about called the profit sharing portion, which is the employer portion, which can now go above that amount up to, I believe it's 65 or 67,000. Don't hold me to the penny, but around that range of what they can contribute from the employer side. So it's not on top of, it's inclusive. So if you happen to have a large profit share, if you happen to have a large contribution on the employer side, that could potentially take up the full 65, 67,000. But if an employee is taking out their income and puts that 20,000, 22,000, whatever that number is, it reduces the employer side to that cap. So as we talk about that, that brings us to the next portion of, aside from just matching dollar for dollar or the 4 to 5, we get to what we call profit sharing plans. Profit sharing plans is something that sits inside or on top of your 401k, which goes into that same bucket, and it's additional money, which the employee doesn't necessarily have to contribute into, but everyone has to be treated equal, because again, this falls under ERISA rules that what's done for one is done for all, and it has to be contributed across the board. So whatever the rule is, it kind of gets distributed evenly across the board to everyone, and it's another way to distribute money and kind of have a bolster to their retirement savings. Now, a lot of times people are talking about how this is good and everything else, but a lot of times it's, oh, it's 65 grand. Maybe you have a very successful business. Maybe you have a business that's very robust and you have incomes that are very high. And let's say you're making $500,000, $600,000, $700,000 a year. Putting away 20 grand is a drop in the bucket. Putting away 65 grand is a drop in the bucket. How much do you have to put away to get to your retirement number? So while this is a foundation, there's a lot of components that build on top of this, but I usually say these are your building blocks. You have your 401k, you have your profit share, which builds up a little bit bigger. The next component, which we build on top of this, is where you get really specialized and get to your higher earners, adding a cash balance plan, adding a defined benefit plan. This is another retirement vehicle that you could add into your planning and compensation. But if you use something called new contribution testing rules, if you have a safe harbor on your profit share and 401k, which kind of protects your lower level employees, you can do a little bit of discrimination and carve outs with your cash balance and defined benefit plans. Now, why is that important? Because if this is designed right and the right rules are in place, a majority of this money can be catered to the population of your employees that you are trying to target. Many times I have clients that 85 to 90% of the money that went into their cash balance plan or their defined benefit plan is going to the owners or some very key employees. Now, you say, oh, it's 80, 90% of that money going to the owners and key employees. Yes. So the 10% that had to go to that other pool or that other segregated portion to allow you to pass testing is far less than what you would have paid if you had to realize that money in tax today. So a lot of times when we're doing owner planning and they have a significant income, this becomes a very powerful tool for them to offset money, to put money away, to really target it towards themselves or some very select key executives. And it's a very underutilized tool in many situations because a lot of advisors aren't familiar with it, aren't working with it. And same goes for CPA and accountants. If you have somebody that's really big in the business market, they know about this, they have the red flags and a little spidey sense that goes off when they see certain numbers. And this is something which, when I see owners hit certain income levels, I automatically go to and say, have you discussed this? Are you aware of what this is? Do you know how to use this? Because now all of a sudden you have an owner who's making $500, $600, $1 million a year. They could put away on top of that $65,000, another $100,000, another $200,000, depending on their age, $250,000. Now, all of a sudden, you're putting away, you're making $1 million a year, you're deducting $150,000, $200,000, $300,000 from that income that's going into this retirement bucket and getting deferred. That's powerful. That's really potentially bringing your income bracket down. So if you have an owner who was potentially making 600 grand a year, and you can get them down to 300, that's a powerful deduction. Because now with personal deductions and other things, that could potentially lower your personal tax bracket while delivering a benefit which you'll receive later on. Now, a lot of the theory behind this is that if you plan properly, you're going to mitigate tax today and be in a tax bracket later on in life so that when you have the distributions, you're in a lower tax bracket. That's not guaranteed. That's not a promise. But if done properly, it gives you the options and the ability to really diversify that and have as many tools at your disposal for today and tomorrow while mitigating and planning to spread that tax potential risk everywhere and potentially have the lowest exposure when designing some of these plans. And these are really when it gets to those core benefits, which now get to, well, what about beyond that? What about if you want to do other things? What if you want to protect and lock in key employees? Again, what we talk about is maybe there's another bonus outside of what we call your qualified retirement money, which gets affected by ERISA, which were those buckets. These are your non-qualified solutions that you can go and do and discriminate and kind of cherry pick by employee who gets them and who doesn't get them. So you have things like retention bonuses. Maybe you have a key executive or a key person who you want to make sure locks in with you for a number of years. A lot of times this is called the golden handcuff. How are you designing it? When do they get it? How do they get what you're looking for? Maybe there's an executive that you just want to have on a set bonus plan and you have an executive bonus structure that's a percentage of what you've made or whatever it is, and you want to spread over a number of years. Maybe there's an executive that you know you want to do something special for their retirement. Maybe you want to do something that's a non-qualified, non-ERISA executive retirement plan, which we call a SERP. There's many ways to design a SERP and many different vehicles from investment to insurance that we can use to design some of these out. And depending on how your business is structured, some of them have tax savings today. Some of them have embedded tax savings that you'll see at distribution. A lot of them have the protection on the accumulation, that you're not getting banged out for tax on the growth of this money if it's sitting in a separate pooled account. So as you design these are another vehicle which you want to explore as you're designing your compensation packages for certain key employees, certain key executives, certain mid-level management. This probably isn't going to be the case for your rank and file employees who are your run-of-the-mill employees. But as you start getting on those upper tier, those carve-out people, those people that are really important to you, these are things you want to design into the compensation package and make sure that you're designing it in such a way that they're getting the money they want, when they want it, how they want it. So some employees might want to get paid different ways, and that's where that kind of gets going. But from there, we get into phantom stock. Phantom stock can be for key executives. This can be for all employees. This is really a driver when an employee is crying that they want equity in the business, but you don't want to give up equity. So phantom stock is an imaginary concept. It's basically a promissory contract between you and the employee saying, based on the value of the company today, and based on the value of something in the future, you can either do the difference between the two, or you can include the underlying value, saying a lot of times it's the difference between the value today and the value in the future of what owners use. It says, hey, the company is worth $1 million today. Based on this, there's a percentage of the company which I'll allocate towards or be put towards you in your phantom stock. And from today until the point that you retire, at that point in the future, the delta or the growth in the company will be awarded to you as a cash payment. And a lot of times that's usually at retirement, that's usually at a certain point in time in the future. Sometimes it's a lump sum, sometimes it's a payment over a number of years. But this is a great vehicle that you don't have to pay out of pocket today that allows employees to feel and get tied to the growth of your business. Many times it's used for key executives, key managements, when you're trying to lock people in to be tied to the growth of your company. You have a $2 million company that you need to be a $6 million company to be acquired. You have a $2 million company that you need to be a $6 million company for you to sell and hit your retirement goals. Well, just because it's your goal as the owner might not align with your goal, with the goal of your employees, because they're there for their salary, they're there for their compensation. If they don't have some matrix or some vehicle to tie them to the growth of the company, some bonus, what's going to drive them to do it? Phantom stock is the most direct correlation that you can use to do that. And that future payout and having different funding vehicles and different ways you can do that is one great option when you're designing out those plans. From there, we get into split dollars. Split dollars are great for C Corps. Maybe you have a C Corp. Maybe you have things that you're an owner and you want to pull money out of the business. A split dollar plan, a split dollar bonus allows you to do a lot of different things to kind of realize money today or realize money at a certain point in time and have the cost be defrayed down the line to a future time. One of the biggest known stories of this is Jim Harbaugh with Michigan. In his compensation package, he had a split dollar loan agreement using life insurance in place to offset a large chunk of his bonus money because he didn't want to realize the cash today. And it was tied to the death benefit, tied to the cash value of the life insurance, which, because it's a loan, you don't pay tax on it. He realized the gain, he realized the profit, he realized the money today, but at that future point in time in the future, the cash value in the life insurance, the death benefit of the life insurance is sitting there to repay the loan. So he ended up with the difference of the delta of that policy, while some of the cash value got pulled out of it to pay the company back for that split dollar loan. Many times with a C Corp, this is used by owners to pull cash out for themselves or some close family members to avoid double taxation. Many times it's used to bonus people money to have it not hit them personally with taxes or hit them in other ways. And it's a way to really mitigate laying out money because the company's really recovering what they loaned in some way, shape, or form from the employee or owner later on. It's just another way to kind of utilize money of the business for personal or employee purposes without having to have that additional tax exposure. Now, I know I covered a lot of topics today and a lot of different things, but it's just a groundwork to kind of give you ideas of what you should be talking to when you're talking to a professional. This is not something that you really go at alone. This is something that you really need to have an advisor who knows business planning, who knows how to think outside the box, who knows how to think from multiple angles. There's personal planning, there's business planning, there's tax, there's legal, there's financial exposures. You need to have a team that works well together and kind of knows all the components and knows your personal situation. Because no two businesses are exactly the same. You have state laws, you have city laws, you have one owner, 5 owners, you have LLCs, S Corp, C Corps, you have 5 employees, 20 employees. They're all different components. And when you start mixing and matching them together, there's endless combinations of situations which make it vital that you have an advisor who can best guide you through the waters of your situation.
All right, well, we have some time for question and answer portion of our webinar now. So I've got several questions kind of in the hopper. I would tell our attendees if you have any more, hurry and get those in so I can ask them. And if we are not able to get to your question, please leave your contact information. We're happy to reach out to you. So with an S Corp, how are taxes determined when it comes to each partner if it's a partnership ownership? Is it equal, or is it depending on their ownership percentage?
So it's usually tied to their ownership percentage because it's going to go back to your K1. So with a S Corp, you're going to get, because it's a pass on, you're going to get K1, and on your K1, it's going to basically say what your percentage of liability or what your percentage of gain was for that year. Now, getting into the nuance of it, does the distribution always line up equally? In an S Corp, yes. In an LLC, not so much, because in an LLC, you can distribute distributions differently. You can distribute losses differently. It's in what's in your operating agreement. But you have to remember, S Corp, you're a shareholder. Whatever your shares are, that's what it's going to relate to what your distribution is and what your liability is. So those are going to kind of pass through that way. And again, like I said, there's different structures that have different benefits. One of the benefits of an LLC is that manipulation. Hey, how are you going to distribute the loss? How are you going to distribute profits? And it doesn't have to be equal in an LLC, which it does in an S Corp. And again, that goes back to something else, which is it's not that you can do it on a whim. It goes back to how your legal documents set up. What does your operating agreement say? What does your partnership agreement say? What does your membership agreement say to this? And those are the rules of the game that you have to play by to make those distributions, and having those drafted properly, having those worded the right way, having those done to kind of meet your goals are essential in designing this.
All right, thank you for that answer. Can you talk about the merits of a 401k versus a simple IRA?
So the merits of a 401k versus a simple IRA are a bunch. The first being, there's a higher limit of there's not that a higher limit, but there is more flexibility, a lot of more variability of how you can handle it. So the distribution of what you put in, what the employer puts in, there's a lot more control and flexibility in how you can do certain things with a 401k versus a simple IRA. And not to get too technical, but more often than not, you can get more money into a 401k than you can a simple IRA. And just how the distribution is, depending on how you take salary, how you take certain components of income, the 401k gives you more flexibility and more often than not, a higher level of contribution of what you can put in if you're looking to really max it out.
Here's another question. This just has to do with a 401k question. If you have a 401k at another employer and you're running your business and you establish a 401k at your business, can you contribute to both, or are you limited? Well, are you limited by that maximum per year?
So the maximum per year is universal across the board. So what you could put in, if you have one 401k or 3 401ks, it's going to be the same. You could have that same cap across the board. You could kind of split it up, and you have to be careful with that. More often than not, I tell people to be very careful and not have multiple 401ks. I know I've seen situations where people have had 2 or 3 401ks, and you have to be extremely careful in how you manage that and how you do certain things. So especially on the employee portion, the employer portion, when you talk about the profit share and some of that other stuff, you get a little bit more flexibility. But where you really get some real flexibility is really adding that defined benefit and other things, depending on what you're looking to do. Again, this is it depends answer, and I can't really give a nailed down answer to your personal situation because there's a few variables that we have to go there, but it depends. Would you? Yes. Is it recommended? It depends. I would not, I wouldn't necessarily do it. You might be obligated to offer it for your employees based on your situation, your tax obligation under the Secure Act or through state law. But you might not be able to contribute to it yourself because of it, which might be an avenue to explore something like a defined benefit plan or to add a profit share or something where you might be able to get some money into it that way to sit alongside your 401k at the other employer.
And I guess this is one of the things I've been thinking about throughout this presentation. It's just each situation is different. Each business is different. The goals every employer has is different. So, so important to work one-on-one with someone who will understand that before making recommendations.
Yeah.
Another question here. Can I set up a solo 401k and convert it to a 401k for employees as I add more people to my business?
So the answer is yes. There are certain platforms. So the answer is yes. And that the way you do that is you set the 401k, but you wouldn't set it up through maybe a solo 401k option like you would do through a Fidelity or a Vanguard on your own. You would have to set it up through a traditional 401k option. And while it will look and feel like a normal 401k, it's still a solo K until you add that employee. So I know there are many companies that will do that. There's a few off the top of my head I can think of, but I know we really don't like pushing products or company names through these types of webinars, but there are avenues that can do that. And I've done it for several clients.
All right, and one more question, kind of wrapping things up. You talked a little bit about possible tax credits for the cost. Can you talk about just the cost of setting up a 401k and how those can maybe be offset?
So I believe, don't hold me to it, I believe the credit's up to $5,000 a year for 3 years, which you get through the Secure Act. Sorry, I'm putting me on the spot to put the number off the top of my head, but I believe it's $5,000 for the first 3 years for setup and cost for beginning a 401k. But that's dollar for dollar what you put in up to that amount. That is the savings. Typically a 401k, depending on how many employees you have, depending on if you're putting a safe harbor, depending with the TPA. I've seen 401ks that have a fixed annual cost or a fixed cost to the employer to set up and run. Usually the initial setup costs anywhere from $500 to $1,500 for the TPA and the record keeper. And then the annual cost on top of that's usually anywhere from $750 to $3,000 per year I've seen for ongoing costs. So anywhere from probably 1,000 to 5,000 or 6,000. If you, well, there's not many larger employees in here. It's usually under 5,000. So probably that 1,000 to 5,000 range is probably the fixed cost to the employer that you're going to see more often than not when you're dealing with a 401k.
And I did look that up. I believe you're correct about the 5,000 for 3 years. So, all right. Well, I think that's about all the time we have for questions. We went right up to the end of the hour here, and we want to thank everyone for being here. If you came in a little later and were not able to see the entire presentation, we have recorded this, and we will be sending out a link to the replay of this event. And you're welcome to share that replay with friends or family, colleagues at your company. And we're really happy to help out if you have questions on top of what we have covered today. I want to thank Robert for being here and for the organizations that have made this webinar possible today. Here at Advice Chaser, we're all about helping you find an advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. We're getting lots of thank yous in the chat, and we thank you for being here, and we hope to see you at another webinar soon. Goodbye, everyone.